So, can you hear me? I'm audible,
Yes,
Yes,
sir.
sir.
and the screen is also visible.
Yes, sir.
Great, great. So, anything which you want to ask from the previous classes? Anyone?
We are starting ARIMA modeling, and if I just quickly show you what we have covered. So we talked about so far introduction to this financial econometrics. We had very long discussion of regression, multiple regression, and then we used dummy variable regression, one of the applications of regression analysis. So this is what we have done. So now we are going to start ARIMA, and after ARIMA we'll be handling VAR. Then we are going to have something known as co-integration and vector error correction model. Then we'll have some discussion on volatility models. This will complicate, we'll have a univariate, we'll have bivariate, and then we'll finish the syllabus with panel data econometrics. This is going to be toughest, most exhaustive thing in the econometrics. So we have done this, we are starting this today. So as we say ARIMA modeling, one of the best uses of ARIMA modeling is that it can be used for forecasting. Very simple examples which you students are when you go to corporate come across, you have got demand for the product and you would like to forecast. Don't think that demand forecasting is only related to marketing people. It comes to everyone. If you want to have the projected balance sheet, financial statement, or even you just want to know the cash flow for the coming years, you need to have projection of demand or sales projection for that matter. So whenever you are looking at the future, you would like to, it's like groping in the dark. In that case, you need to have something so that you can confidently, relatively not that uncertain, you would like to use some method. And that's why business forecasting is again a very important area, not only for academic but for practitioners as well. So one example, demand forecasting, sales forecasting. If I just go more typically for the finance students or finance area, then you have got stock forecasting for the stock. Have different ways to know the stock prices. We go for equity research, or we call it security analysis. Equity research or security analysis can be said one and the same thing. So broadly, you'll find that this is done in two ways. We have got fundamental analysis and technical analysis. And then within fundamental analysis, you have got DCF, discounted cash flow, and relative valuation, and this technical analysis, which is nothing but the charting. So what is happening? I guess you know that this is based upon past data. So as such, when we talk about technical analysis, or technicians do not talk about anything projected. Rather, they look at the previous data and they try to figure out what would be the future. So predominantly TA talks about the historical thing, and from there they try to talk about the future. On the other hand, when we talk about fundamental analysis of equity research or security analysis, we are invariably interested in giving the inputs of future. So whenever I say that I have to give the information about future, it makes sense that I talk about future prices of stocks. Within this, I can use one more thing known as portfolio management. So any GK type answer to this issue? What is portfolio management? Yes. What is portfolio management? What is portfolio? Come on, unmute and speak.
The portfolio is a bucket of investments that we make, that a manager makes, and a manager just manages all those investments for people or for individual himself. So that's what's portfolio management.
So what are the concerns with, I want somebody else to answer. What are the concerns with portfolio? If I just take quick input, what has been just said, portfolio, let's say for argument's sake, I took only equity portfolio, diversified equity, I've got 2 stocks. And my issue is that I would like to have a portfolio of 2 stocks. Now tell me what are the concerns which equity analyst as well as portfolio managers or this fund managers, they quite often come across. What are the concerns of portfolio management?
So in the portfolio of just 2 stocks, we can say that it is not diversified much. So
No, let's leave that. We are talking about portfolio of 2 stocks for the sake of simplicity of the discussion. There is no other point. So we are saying the same thing. That's not the concern. Diversification should be there. That is by default. That is by the very nature of the portfolio. Don't worry, that's not point of discussion. My question is, what are the concerns while somebody makes the portfolio? Diversification, suppose that is taken for granted. I'm waiting. What are the concerns? Just use your common sense. Trust me. Yeah.
Risk reward trade-off, sir.
1%.
Okay, just a moment.
Yeah. Please tell me. 1%. Both of you have muted. 1%.
Sir, for a portfolio, how much risk we take and how much reward we'll get. So that is the concern.
Good. You talk about risk and return. Perfectly all right. Risk and return, you call it reward or you call it return, same thing. So this is the answer that we bother about risk and return. So when we have portfolio, then question comes in what proportion? What should be the weight of first? This is the portfolio. Let's say I'm saying that. So this is the total portfolio. So total money, if it is invested, then let's say I've got let's say 10 CR, 10 crores. So how much goes in S1? How much goes to S2? That is something which is important. So decision of these 2 weights. Likewise, suppose you have got 10 stocks portfolio, then again, in what proportion money should be distributed in those 10 stocks will decide ultimately what is the return of the portfolio. RP stands for. And when we say risk is usually shown with the help of sigma, standard deviations, sigma p. So these 2 become concerns. So my question is, when we want to know return of the portfolio, obviously one concern is this. I'm not denying the fact. But another concern is when we decide the weights, one of the method is Markovitch portfolio theory. You will come across these things in next semester, Markovitch portfolio theory. And you might use this operation research to linear programming methodology, and you might optimize this ratio ZP by sigma p, if I just say RF, something like that. This is the thing which you try to, this will become your maximization function if you are following slightly the operation research or linear programming. Then this is what we try to maximize. So when we try to maximize, obviously, what we are looking at, what are these? But when we use this option of trying to maximize this so that these can be solved, question is we have to have return 1, return 2. So similarly, we need to have sigma 1 and sigma 2. Are you understanding what I'm saying? If I have to decide about the weights in a portfolio so that this return by risk is maximized, means return per risk is maximized. But before that, I need to know R1 means return of first security or first share and risk of first security. Similarly, I need to have return of second security and risk of the second security. There are two ways. You can take historical values, historical. But when we say historical values of R1 and sigma 1, that's not very great thing. Theoretically, when we are talking about fundamental analysis, as I said, and there I'm talking about making the portfolio, in that case, I should be futuristic, means I need to forecast these returns. Are you with me?
Yes, sir.
So what I'm saying, if you want to make portfolio and you want to optimize it so that return per unit of risk is maximized, you need to have future values. It means you need to forecast the return, or you should know the future price. When you know the future price only, then you can calculate P2 minus P1 by P1, and then you will get to know what is R1. So this should be the future price. Similarly, sigma should also be futuristic. What would be the standard deviation or volatility in the future? So it means there should be some method by which this can be forecast, and this can also be forecast. If I try to tell you where I'm going to do this, so for you, these two tools, precisely ARIMA, and if I slightly go to make it a little complicated, I can use. So this may tell you, this may help you to forecast the return on these stocks. And as we talk about forecasting the volatility or knowing the future value of sigma, these methods will be handy. And you can have, this is univariate, this is bivariate or multivariate. This is univariate and will have bivariate method of volatility models. So all are going to be part and parcel of what we are going to discuss in coming sessions. I hope I'm able to make sense what we are going to do, why we are doing. So when we study ARIMA and VAR next chapter, we are interested in knowing the future value, which becomes essentially very important for several reasons, that what is the best future estimate of stock price. So there are different ways, but forecasting is also one of the ways by which we do, because we also try to calculate future value with the help of DCF or relative valuation, or with the help of technical analysis. These are also the ways, but what we are going to do, that is also ways by which we can get to know what is the future price of the stock or future risk of the stock. Risk is nothing but sigma. So this is the rough idea, rough introduction about utility of ARIMA. When I say ARIMA modeling, what happened? Before I start ARIMA, let me give you a little bit idea about business forecasting. Business forecasting, when I say, then there are practically, I'm just having some successive take on and try. So here you will find statistical method of forecasting, statistical method. When I say statistical method, I'm talking about your smoothing methods like moving average, even simple average can also be used, or other smoothing method like exponential smoothing method or exponential moving average, weighted moving average. So there are different tools which come under the broad category of statistical method or business forecasting. Then if I talk about advanced, then nowadays we have got machine learning. So machine learning tools, here we know things in very basic. Here there's completely black box. We do not know how it is happening, but we have put the input and we have got the output. We have tested the output, but what is happening is not known. We have only the methodology, but what exactly how the methodology is operating is not known. That's why that comes under the category of machine learning. In between, you find something known as econometric method, something which we are going to use right now. These are econometric method. So in this category, I mean, till the time this was not popular, you would have found that this was prevailing, and still it prevails for several reasons. But this is the broad categorization of business forecasting tools. So one of the most popular, accepted, and people appreciated this method is known as ARIMA method for business forecasting. VAR can also be used, even simple regression can also be used. But despite that, this is most popular. We'll have some discussion, some points in that context right now. So this is the idea about the world of business forecasting, statistical method, machine learning tools, and then econometric methods, which we are going to handle, especially ARIMA. Before I start discussing about the ARIMA, I would like to talk about type of data from one context. So far, that context I have not touched. Type of data. So far, majority of the data set what we have got, they were cross-sectional data. Cross-sectional data means time is one, time is same. Means I've got data of profit. Profit at this point of time, whatever data will come, let's say from BSE 30, Sensex, BSE Sensex 30 companies are there. So 30 companies net profit today is an example of cross-sectional data. Second set, as you have done your assignment, time series. Time series, as you have calculated your profit. Again, I'm sticking to profit just for the sake of example. So I've got profit and I have got, let's say, last 15 years. So 2020, 2019, likewise, you have got, let's say, 2001. And here you're having the, let's say, call X1, and I have got data. So this is one example of a time series. In time series, what happened? I could have another thing like operating profit, or I could have got, let's say, the operating expenditure. So all these things I can have for a particular company, for a company A, time period, and the variables. So individually, I could say right now I've got 3 time series. So every time this is one time series, this is another time series, this is third time series. So one thing we can conclude that time series is basically of 2 variables, where one variable is time. So any denomination of time can be there. Time can be in days, weeks, months. But whenever you have data of 2 variables, where one variable is time, as you are finding, we have got net profit and over the period of time. So this is one time series. Operating profit over the period of time. This is another example of time series. Operating expenditure with respect to time. It's an example of third time series. So time series has got always 2 variables, where one variable is some denomination of time. Here it is years. I could have got 6 monthly data. I could have quarterly data. I could have got monthly data. So here the time denomination will be month, year, week, whatever it is. And here I have got the values of the variable. So that becomes the example. That becomes one time series, and that is the example of time series data. Are we together Anyone has got any problem? Any point? So third is panel data. I'm just giving you introduction so that third type of data is panel data. Panel data is nested data. It can be presented two ways. Suppose I have got 3 years and 5 companies. So this data I'm showing you, panel data is practically a combination of cross-sectional and time series. When they are put together, it becomes panel data. I'm going to show you two methods by which panel data information can be presented. Let's say here, 2017, 3 years, so 2017, 2018, 2019. And I've got company C1, C2, C3, C4, C5. And here I can have as many variables as I want. Here I can have as many variables as I want. I can have Y, I can have X. So I can have Y, I can have X1, I can have X2, as many variables as I want, I can have. That's not a problem. So let me complete the format. 2018, this is C1, C2, C3, C4, C5. And then I have got 2019. Then I've got C1, C2, C3, C4, C5. This is the one way by which, this is one of the examples where companies are nested with the time. That is the example of one type of representation of panel data. Both are examples. Second example, so I'm going to show you. Second example can be, I'm starting with the company here. Time is involved with the companies, or time is involved with the cross-sectional. So C1 2017, 2018, 2019. Then I've got C2. I'll repeat time the way there I was repeating companies 2019. Likewise, I'm just showing you with the dot dot. So here I've got C5, 2017, 2018, and 2019. So these are the two ways. Again, this story remains same. Y, X1, X2, X3, as many as I have, no problem. So these are the two ways by which panel data can be represented or panel data can be put for further processing. So panel data is a combination of previous two methods, previous two types of data, cross-sectional and time series. Anyone has got any question or doubt? So as we move forward in the discussion of ARIMA modeling, when we talk about time series data, so right now, first thing that ARIMA means application of time series. This is the simplest thing. So ARIMA is applied only on time series. So when we say time series has got several features which are not there with the cross-sectional data. First thing is sample. Anyone can tell me what is the sample in a time series data?
For a particular observation of at a particular
In a
time.
way we can say that time period is the sample. When we say sample size in a time series data, it is nothing but the time period. Let's say I'm talking about annual data. I mean, time denomination is annual, and I'm talking about last 15 years. So sample size will be 15 years. So I've got observations of last 15 years. So in a time series, sample is nothing but the time. Then frequency issues is also very much prevalent, because if you talk about stock market, practically you have got the price, continuous pricing is there whenever the stock market is going on. Every second you have got a price. So high frequency data can also be seen when you are talking about time series, which is usually not the case when we talk about cross-sectional. There are many other features, but one more important feature is we call it autocorrelation. If you have remember, we discussed when we were talking about regression analysis, I said that we'll be touching this thing later on. So this is the right time. Autocorrelation, what is this? It says what happened that when we talk about, let's say, a time series YT is one time series. So autocorrelation property says if you are running some regression of this YT and you are generating the error term UT. So what happened that UT covariance between UT and UT plus K should be 0. K can be more than 1. So this property, whenever you are running a regression of time series, you get the error term, the correlation of error term with its own lagged values. K can be, K represents the different time period, T plus K. So it involves the previous values also. Or I may write it other way also, but representation is okay. T plus K we write. So it means that the error term, whether previous values or future values for that matter, in either ways. So let me correct it. This not actually correct. So K maybe we can call K is not 0. That's it. This will work. Otherwise, that will be only the standard deviation or variance for that matter. So when K is not equal to 0. So here is that the error term should not be correlated with the previous values or the future values. If that is there, we'll say that there is no autocorrelation. So what happened when we talk about optimum least square, we have talked about heteroscedasticity, we have talked about multicollinearity, and third thing is autocorrelation. So to have appropriate application of optimum least square, when you have time series data and you are running time series regression data, regression or using time series data, then the error term should not be having any association with its previous values or future value. And that property is known as autocorrelation. And we have partly discussed that during your assignment is no autocorrelation, and H alternate is there is autocorrelation. This is the hypothesis we test, and test can be done by diagnostic testing in eViews as well as in Stata. Stata have given B Godfrey, E-stat B Godfrey test, and there you have to look at the p-value, and if the p-value is less than 0.05, you will say that there is problem autocorrelation, and if p-value is not less than 0.05, you will say null cannot be rejected, and there is no problem autocorrelation in the data. Are we there? Anyone? Any problem?
So, am I audible?
Yeah.
Yes, sir. So, in case if the p-value is greater than 5%, so that means that the covariance between an error term and any preceding or succeeding error term will be 0, right?
We'll say that the data suffers from the problem of autocorrelation. So
in case
application of OLS is questionable in that case.
Yes, sir. So in case there are higher values, for example, of P, for example, it is like 89%, 90%. So how is the strength interpreted in this case, sir? Like the value of P, how can you interpret it? Like a higher value of P would mean what, and a lower value of P if there is no case of autocorrelation?
P-value, there's a simple rule that it should be less than 0.05, you can call it 5%, then null is rejected, right? So if you are saying that p-value is more than 0.05, you will say that we do not have sufficient evidence to reject the null, rather we have to accept the null. That's it.
Yes, sir, that point I got it, sir.
Mm-hmm.
So my question was that, for example, if the p-value is, for example, 10%, and for another data it is 80%. So how will you?
No. There is nothing like that, because if you try to understand this, this is the idea about p-value. Suppose, these are and you have run, let's say, t-test, and you are finding that your t estimated is coming here. So what will happen that this area from plus infinity, so this whole area, shaded area, will obviously be more than 0.25%, because this is 2.5%. So let's say for argument's sake, this is 10%, as you are saying. So p-value is 10%, and means that the t estimated is not falling in the rejection region. So the null cannot be rejected. That's it. There is no further interpretation. On the contrary, if p-value is very low, means less than 0.05 should be there, and very low. So if I compare between p-values, two p-values, if I want to compare, one is 0.045 and 0.000. So I'll say that this level of significance is very high, and this level of significance is less meaningful, because in this case, t estimated is somewhere here only at the border. In this case, but if I talk about in this case, this will be somewhere here. So it means when I'm having p-value, but which is very small, then I'll say that significance is very strong. Null is strongly rejected. So value non-zero, or here, let's say, for example, heteroscedasticity is very strong. Are you with me? So
Yes.
more value of p-value, more value than 0.05 has no significance, but lesser value like this has got some meaning.
Okay, sir. Okay, sure.
Any other thing?
No, sir, I'm clear, sir.
Any other question? So we have partly discussed autocorrelation issue. We're continuing with ARIMA discussion. Before we start ARIMA, one more thing which we have to talk about is the stationarity. We are talking about the stationarity again because we have got time series at our disposal. Stationarity is a feature which is there for time series. Stationarity, as the term itself says, that if you are having a time series, it should have three features. If any of these three features are not there, then the time series is not stationary. And if time series is not stationary, then what happens if you run any type of association, or if you run any type of regression, if time series is not stationary, then regression will give you spurious, or you could say not appropriate, not correct regression results, because your time series is not stationary. I'm repeating myself. Whenever we handle time series data, when we have to handle time series data, precondition, there are some exceptions I'll discuss, but except those conditions, precondition of using any type of analysis of time series should be stationary. I'll discuss three features of stationarity, but condition I want you to understand. Before we process time series, we have to check whether time series is stationary or not. So right now I'll discuss about what do I mean when I say time series stationary or stationary time series, and I'll tell you what is the process by which we can check the stationarity in a time series. Three things which are there when we say time series, stationarity in the time series is that, let's say I have a time series. I'm just trying to give you a graph. This is time. So let's say this is time series. So I've got, let's say, two time period. This is one time period, delta t1. And here I'm talking about delta t2, means obviously I'm saying 2t minus t1. And here I'm talking about dash, another time period. So if I'm having these two time periods in a time series data, are you clear with this? Graph is clear to you? Come
Yes,
on, guys,
sir.
you have to nod. Yes. Okay.
Yes, sir.
So what is happening when I have got time series at two time interval? I mean, I'm not saying whether, let's say for argument's sake, these durations are same. I can, exempt that also. That's not the, that relevant thing right now. So what I'm saying that mu1, which is nothing but the mean mu1, and here the mean is mu2. Mu means average or mean value of the time series during this period. And during this period, the mean value mu1. Similarly, when I say variance sigma 1 is square, and here it is sigma 2 square, variance during this period, during this period. So stationarity says that mu1 should be equal to mu2, sigma 1 square should be sigma 2 square. So this plus another feature which is required, we say that covariance between yt, yt I'm showing as time series. Yt is my time series. Yt is my time series. So plus, sorry. What happened? Something I will handle that issue later on issues. So I'll say much. So I was saying t plus k should be a constant. This is the third feature which I'm talking about. As I said that, and this should be constant. The covariance between these two terms should be constant, and as k tends to infinity, this covariance should tends to 0. So when these three features are there in the time series, we call it time series is stationary. Yeah. So in a normal way, it is slightly difficult to comprehend the meaning of time series, but you can say that if a trend is there, then the mean value should be same all over the time series. So practically when I'm not saying that if there is a trend, then the series will always be non-stationary. I'm not saying rather we statistically test that when we have two time periods, then average at this time, average value of the time series, average value of time series during this period, the average should be same, covariances should be same, and covariance between one value and value after k time period, the covariance should be constant, And as we increase the K, this covariance should tend to zero. If these three features are there, then we say that my time series is stationary. So stationarity, in a way, a feature which tries to bring the consistency in the nature of time series. So we say that if we want to run any type of analysis using time series, then we have to test for stationarity, or we have to make sure that these three features are there in the time series. And if I have to do that, then I have got certain tests, and those tests are known as Dickey-Fuller, Dickey, D-I-C-K-E-Y, Dickey-Fuller test, augmented Dickey-Fuller, or just Dickey-Fuller, augmented Dickey-Fuller, or Dickey-Fuller test, or we also call it unit root test. Names are not that relevant. Any name you can use interchangeably. And or we have got a few more types of unit root test. All of them we call unit root test, and we say that data is having stationarity. So null of stationarity. So no, sorry, other way around. I have written it. Null of no stationarity. No stationarity, and there is stationarity. So this is the pair of hypothesis which we have to test whenever we want to test for unit root test, and we want that stationarity should be there, and that's why we look that the unit root test should be significant. So null is data or time series is not stationary. Alternate is it is stationary. So we look forward to rejection of the pair of hypothesis of unit root test so that our data or time series becomes stationary. I'll show to you so that at least this part gets over. I have some data at my disposal. I'll bring the caselet which I'm planning to use, or I can do that. Let me finish this. Let's say I've got some stock price of Chinese stock exchange, or I have got data of BSE also. So BSE for some different time period I'm having. I have to test for unit root test. I'll go for view, and there we are finding unit root test. We'll go for standard unit root test. I repeat, we'll open the time series. We'll go for view. We'll run the standard unit root test and augmented Dickey. We have got other tests also, but we'll go for conventional test. The rest of the default setting we won't disturb. We'll go for OK. And this is the test statistics which we are looking forward to. This is the relevant p-value. As you are finding that relevant p-value is 0.8901. So the p-value in this case in the China time series, I mean the BSE right now we have used BSE. So in BSE what we have found is that p-value is coming out to be 0.892, which is not less than 0.05. So we'll say that null cannot be rejected. So this time series is not stationary. You with me?
Yes, sir.
So what happened? Invariably, most of the time series, as we will find that most of the time series which are related to the finance world, or we'll say that financial time series, most of them are non-stationary. So now the question is, it means are we not able to, or we will not be able to run the regression or any other thing on financial time series because they are not stationary. So the wire media is, when we say time series, we say that time series can be in level. Level means as it is, as it is. We have got values T1, T2, T3, let's say T10. So I've got 10 observations. This is in level. But suppose I go for first difference. We call it first difference. When we say first difference, it means what we are doing, We have got 10, obviously. When we go for some transformation like this, T2 minus T1, T3 minus T2. Likewise, if I do this transformation, T4 minus T3, T5 minus T4, T6 minus T5, T7 minus T6, and T8 minus T7, T9 minus T8, and T10 minus T9. What you're finding, we are left with obviously 9 data. So 1 degrees of freedom goes away. But good thing is, usually, I repeat myself, usually the financial time series are stationary. Financial time series are usually stationary in first difference. So this is the solution. We surely check before we run the regression or any other operation on time series data for stationarity. And if time series is not stationary, then usually we go for first difference. And when we go for first difference, usually we find that the time series is stationary. I can demonstrate to you right now. I've got BSc, I'm opening it. I said that we'll go for unit 2 test using the standard unit 2 test. I clicked it. As you are finding here, one of the option is first difference. So what I have done manually on the whiteboard, that can be done by the computer automatically. And what we are finding here, the same test. Now we are finding that the null of non-stationarity can be rejected. This non-stationarity of null, because p-value is 0.0001, which is less than 0.05, so null can be rejected. So we can conclude that the BSc time series in first difference is stationary. So this can be concluded that if I have to run the regression, then I can do that, but not in the levels, but in first difference. There are some extreme cases, rare cases, when we go for second differencing also. So means this differencing process, which I showed you right now, that is repeated one more time. And then we test for stationarity, but those are rare cases and a very rare situation you will find. And you can see that that option is also available. I mean, you can go for second difference. Just because it is stationary already in the first difference, it will remain stationary in the second difference as well. But there could have been a situation where you have got data and you haven't got stationarity after you going for first difference, then it is suggested that go for second difference. So if I conclude the discussion of stationarity, then I'll say stationarity is a feature which is there in the data so that we ensure that there is some amount of consistency which is present in the data or in time series, and only then it is recommended that you run for any type of analysis on the time series. And if your time series is not a stationarity, it is not having the feature of stationarity, it means there is some problem of disturbance which cannot be modeled, and that's why if the data or time series is not stationary and you run any type of regression, the result of non-stationary time series or data analysis on non-stationary time series cannot be relied upon. It's not that results will not come. Results will come, but reliability of those results are questionable if data or time series is non-stationary. Are you with me? All of you? Stationarity is slightly heavy dose. If you have problem, please discuss. This is grave injustice when you have a problem and you don't ask because somebody else is asking. Be very, very selfish. It is your learning which is very important. You as an individual, very important person. Think about you. Ask question if you have. Don't worry what others are doing. It's none of your business. You think about yourself. Are you clear? Good. Not clear? Please speak up.
So the Covey stationarity is defined by three things, right? Mean,
Yeah,
covariance,
precondition. Perfectly all right. Whenever we are handling the time series, so Stationarity is a precondition.
And it's measured like by three things: mean, covariance, and
Actually,
variance.
we don't do it. I mean, we just test the unit root test. We just do the unit root test. But conceptually, we need to understand that when we have a time series, then for any time, two time intervals, the mean value, variance, and this association of covariance should be constant. If these three things are meeting, and this is also extreme case when k, I mean, the difference between these two becomes infinite, then covariance between these two should become zero. If these three features are there, we say that time series is having the property of stationarity and can be further processed.
And the mu value, it represents the mean, right?
Come again?
The mu value, the
Should be constant. Yeah, mean value should be constant.
it represents the mean of the time series data.
Yes.
Okay. Okay, sir.
I'll show you quickly one graph. Look at the graph of this BSc time series, which I'm showing you. So this is the time series which is there. But this time series is in level. This I have drawn in level. So this level time series is having the this feature. So which we call that this is not, and we have tested also, it is not stationary. So it is having some problem of inconsistency or non-stationarity. If I quickly try to show you, I have to just generate a series. Generate. There's an option, direct option. Yeah, generate series. I'll say that DBSC and DBSC. This command directly gives me the first difference time series. So I've got a time series. This time series is first difference of BSC. If I show you the graph, then you can see I can show you both the graphs together also. And this is the nature of first difference BSc time series. You're finding that some part of, some sort of consistency would have come. It's not that variations are not there, but the consistency has come, which is within the acceptable definition of stationarity.
Okay, sir.
Sir, can you please show the stationarity test on Strata as well, sir?
Strata, I often don't remember. And I'll share with you through your CS command, dicky pool or something like that. Is it? I don't remember all that.
Okay, sir. Not a problem.
Arima will be doing on Arima and VAR will be doing on invariably on EViews, because the features of EViews is strong for running these two tests, but interchangeably it can be done, no problem. We'll be using Strata now more for panel data, which is the advanced thing of econometrics. And I'll see to it where I think that you guys will be more comfortable when I talk about volatility models. So, but right now, 2-3 chapters continuously will be using EViews predominantly. But if you have asked, I'll provide you. By today, you'll get it. I'll request your CS to provide you the command. Any other question?
Sir, I have a doubt with regard to that first difference. My question is, if we find out that if we run this test, Dickey-Fuller test, and then we find out that data is not stationary, then we take the first difference and we try to check if run the test again. So how many times can we keep running the test? You said that
usually, as I said, that 99% in either the time series will be stationary in levels, 5% cases. For example, let's say I was running the volatility of using volatility model, GASH model of Sensex, of future values, which I got from derivative portal of NSE. Then I've got prices of options, let's say for 5 years. And I just calculated the volatility values of all the 3 time series: Sensex volatility, future prices volatility, and option price. I had this idea that I will be having a normal situation of stationarity at first difference. But to my stark surprise, this happened last year, so it's fresh in my mind, where some deviation was there from the usual behavior of time series. I found that the last 2 time series were stationary even at level. So my plan of using first difference, because I was using some property where it was mandatory that I have to have first difference stationarity, but I couldn't use that plan because the data happens to be stationary in level. So good number of occasions you will find that data is stationary in level. It's not that you won't find. Then let's say 95% cases or 90% cases, if I give you a little more conservative figure, you will be getting the stationary at first difference. So hardly remote cases of 1 or 2%, you will find cases where you may have to think of going for second level of differential. So beyond that, so far I haven't seen any time series which is not stationary after two differences. But theoretically, we can go ahead. But practically, I have not seen.
Sir, another question is that if we face such kind of problems, does this mean that the data is bad or we need to replace the data or something like that?
No. As I told you, I collected the volatility prices. So now I know with my understanding that volatility values are stationary at levels. So when you do the data analysis, quite often you have fair amount of idea about what type of time series will give you stationarity at level, first difference, second difference. So as you become experienced in handling data, you develop the understanding.
Okay, thank you, sir.
So coming back to the features of ARIMA, we'll talk about ARIMA modeling. So when we say ARIMA modeling, ARIMA is made up of three things. AR, I stands for integrated. Integrated. I'm writing full so that you have to write integrated. This is G, integrated. And then we have got MA. So what happened? These are three parts of an ARIMA series. Autoregressive means if I'm having YT. So autoregressive means the lagged values of Y. Let's say I'm talking about only one lag. I could have 2, 3, 4. That is known as P. The number of lag is shown with the help of P. Integrated, it means that it is stationary at what? Means if it is stationary at level, it is I0. If it is stationary at first difference, this is I1. And if it is stationary at the second difference, it is I0. So time series, before it is run for ARIMA modeling, the stationarity has to be checked and then we run it. So the level at which, I mean, whether it is 0 level, 1 level or second level at which the stationarity is seen, that becomes the second component. We call it D. So this is P, means what is the order of AR, autoregressive term. Means how many lags of its own term, Y lag of Y. Then when we say, then we have to have a term which is known as white noise process. I'm complicating, but I should give you conceptual thing. White noise term, or just for the sake of simplicity, this is good enough to say random term. When I say random term, then obviously this is stationary. You can take this for granted that it has got all the features of a stationary time series. So a random term. So random term, in a typical situation, I'm not giving you that much data. If you want, meet me offline, I'll give you full data, full information. So for you, it is enough to understand that MA is nothing but the some time series based upon the error term. And here I get to know Q. What is the lagged values? Let's say it means I'm saying that Q, I used P here, I used D here, and I'm using Q. Q is the lag of random term. So right now I can say Q is equal to 1. Similarly, if I'm talking about, let's say, BSE, so I can say BSE is stationary as first difference, so D is equal to 1. And here, let's say I'm talking about only one error term and one auto term. I mean, if time series is YT, then one lag of this term. So I'm saying that P is equal to 1. So this is one example of, I can write it this way if I'm writing what is the ARIMA So I'll write this as the coordinates of ARIMA. So it means yt is written as beta 0 plus yt minus 1 plus e square, we show it by e square, variance, e square error term, square of the error term, minus t minus 1. I think this isn't variance, I can leave it. Sorry, I'll put the e only, not e square. So this is e t minus 1. Again, I have to have the beta 1, I have to write down beta 2 plus the error term as it is. And this is the example. And I'm taking this that yt is the stationarity at 5. This is the example of writing the, here there is no coefficient, I'll write it again clean. Yt is equal to beta 0 plus beta 1 yt minus 1 plus et minus 1 beta 2 plus et. So this becomes an example of one ARIMA 111 model. That much headache we are not going to do when we actually have a time series. We'll quickly use software and we'll move on. I've shared with you some amount and what is the one component in which the time series is decided. You look at this is t and these are t minus 1. There is no other contemporaneous term, rather all are previous terms, lagged values. So it means the present value of time series is dependent upon its own lag term and the lagged term of the random process. And this is t, but this is the error term, which is unobserved part. This is the unobserved part, which is always there whenever we run a regression. When we run a normal regression, what happened that beta 0 plus beta 1 x1 plus error. So right now we are talking about time series, so this becomes error term. So I'm writing it et because it is the style of writing, because here also we are having the error term. So what happened, ut supposed to be the same, these are same thing. So error term is all the time there, unobserved, and these are observed parts. So these are the observed parts. If I just try to differentiate, these are the observed parts, and this is unobserved, error term, unobserved, and these are observed parts. So that is the brief regression equation or expression of ARIMA modeling. But that is not what we do. When we actually run the ARIMA model, we take the help of softwares and we quickly go about forecasting the time series what we have at our disposal. But some amount of theoretical clarity is needed. That's why I shared with you. The forum is open. If you have any doubt, quickly ask so that I can move on.
Sir, I have a doubt. So could you just explain the significance of P? Like, what do you mean by number of lags?
Number of lags, if in the model it is coming out that when I'm running the specification of ARIMA model, then how many lag terms of its own value it is taking, means up to what lag of its own terms are having the capacity to help in deciding the future value of y. So that is what P is. If let's say here I have got P is equal to 2, then if I have got P is equal to 2, D is equal to 1, and Q is equal to 1, the way I'm writing. So here I'll quickly add one more term, let's say beta 3 yt minus 2. So it's all specification, how you are having the expression of your ARIMA equation. There can be one or two more explanation, but those parts I have not discussed with you, so I'm not venturing into that. You lost?
Yeah, sir. Yeah, that's it, sir.
So you want that deeper explanation? Meet me offline. I'll provide you whatever you want. That's not a problem.
Okay, sir.
I don't want to discourage your inquisitive. Anyone has got any other problem? Right. So this is the econometric or mathematical expressions of ARIMA modeling. But when we actually run it, so we don't do it, we don't think that much, rather we have simple ways to do it. And our job is to keep it simple so that it can practically be used. I tell you, there are many occasions where you can use it. As I told you that next semester you will be having a course on security analysis and portfolio management, where you are supposed to know the future value of share price, future value of volatility. And if you are not making best use of ARIMA modeling, then I think that you are not using the knowledge. You have something, and as right now within 15-20 minutes, I'll show to you how you will be able to run it. So it means you are not doing justice with the knowledge, or you do not have courage to apply knowledge on the real life. So ARIMA modeling, especially when you are having any case, competition or any other exercise, extracurricular activity, or you are facing some competition, you will get plenty of occasions where you can forecast. And there you will find that this comes out to be very handy. I'm showing you simple. I've got, let's say, I've got one caselet. I've shared this material with you, all the data with you. So October 2015 to September 2020, I've got data of Sensex. I've just got the price, weekly price. As you're finding that, I've got weekly price. So practically weekly, if I've got, then I'm having data of 2015. So roughly I've got data how much, exact number is 262 data, 262 first, 262 data I've got. So I'll open a new worksheet. I'll close this, so there's no point of duplication. No. So I'm opening 262. And I've gone into, I have to copy. So, you know, I have got return, I've calculated return. If you understand, return is, I don't want to digress right now. I've taken the natural log return. I'll explain to you some other day. I mean, if I have to calculate the return, then we also calculate the return by P2 by P1. P2 by P1 means this divided by this. I'll tell you how it is equal to P2 minus P1 by P1. That is also a return. So here it comes. If you these two are same, if you use P2 minus P1 by P1, you will find that things are coming out to be more or less same. If I quickly show you. So this will come same. So as you're finding that these are not different, but these two are not different. They have been just calculated differently. So I'll come back to this discussion at some other point of time. Right now, usually we take the natural log returns. So that is what I have calculated. But I'll make use of only this thing. And if there's a need, I'll go for the return. Otherwise, I'll manage with this. Pasted. Yeah, remove the group. I've got and I'll go for level. I've taken census data from Provis, and what you are finding that p-value is 0.6037. So null of non-stationarity cannot be rejected. Null of non-stationarity cannot be rejected. So data is non-stationary, and I'll try it out at first difference. And what we are finding that it is giving me a p-value which is less than 0.05. So I can say that my time series Sensex prices are stationary at first difference. So I can quickly calculate the first difference series using this command which I did. Sensex is equal to D in bracket Sensex. So when I run this, generate a new series, it is just a name. You can give any other name and put D. D is the operator, and just here in bracket put the name of the series. You will have a new series. If same thing will come as we have tested in first difference. Right now I'll test at level, and you will find that the first difference time series is stationary at level. So it means I'm ready. If I'm running, I want to know the, look at here, a few corrections I need to do. 262. So let's say I'm knocking out last two values intentionally, knocking out last. Three values, no problem. So I've got data only up to 259. I have kept last 3 weeks as free so that I can use them. I don't want all the data to be used for forecasting or for modeling so that I can forecast these 3 time periods. So I would be using 259 observations to make a ARIMA model, and then I'll use the model made with the help of 259 observations so that I can forecast in the future. I'm assuming that I do not know. Suppose I knew, then I would have taken a time series, the worksheet of 265 observations. And if I have data up to 262, so 3 would have remained vacant. And that I could have used for forecasting. So unless until I have some vacant observations, I can't go for forecasting, estimating the forecast. So that is the only trick because I'm keeping the forecasting part also in mind. So I'm just doing it. So nothing will change even if I have done this. I can, show to you. I'm testing for unit root. Everything will remain same. There's no difference by knocking out last 3 values. So if I have to, are you with me? So what I have done, I just wanted to have, my job is to, right now what I'm looking forward to that I would like to have the forecast value, Sensex forecast for next 3 weeks. Are you with me? You are with me?
Sir. Yes, sir.
We have data, and I have got data of 2015 to 2020, and I have taken 259 observations of week's data. And with the help of that, I would like to go for 260th, 261st, and 262nd week. So that information I'm going to forecast with the help of my ARIMA model, which I'm going to make. So going back, the method is, first of all, I have got a time series which is stationary. That is necessary. And then what I'll do, I'll go for proc. There's an option. Are you finding it? Proc, PROC. I'll click it, and I've got automatic ARIMA forecasting. This is the feature. That's why I'm not using Stata, because that feature is not available in Stata. So ARIMA modeling becomes complicated if you do not have such help with you. So I've got a stationary time series which I want to forecast, and I have got some observations vacant so that I will be able to generate the forecast values for them. And then I'm going for proc automatic ARIMA forecasting. I'm clicking it. This is the default message which will come. Here you pick the auto. Don't go for none, log, or something. Go for none, sorry. Go for none. Don't go for any other option, so that the manual result, we'll be running it manually also. I'll show to you. And we are running with the help of automatic method. So there should be consistency. If I let the auto, then anything can be done by the system, which I'm not interested. So maximum difference it is saying showing you two just because we are using the stationary time series. So obviously max difference. It will give you the feature, you know, P, Q and P, D and Q, all three coefficients it will give. So obviously it will come 0. ARP we are giving, we can increase, but as a matter of convention, we'll take 4 because more than 4 may not be parsimony. I mean, parsimony is an important feature which we look forward to. We don't want very complicated model. We want a model which is having lesser independent or exogenous variables so that model is handy. Because when you have more number of variables, that becomes complicated, and complication brings more number of errors also. Every variable brings some good features and bad feature. So bad feature is the error. So that's why number of items should be kept limited so that the error should also be limited. So that is the logic. And here I can go for option. I guess this is clear. I haven't done, I have ensured that none is selected and I'm not touching anything. I'm letting all the default setting remain as it is. Going for option because we are going to, you know, we'll be needing some help to decide it will be deciding, but we are going to do some more things. So we need table, criteria table, ARMA criteria table, we need to tick. And output forecast, we don't need, but will be generated. We can't stop it, let it be, we'll delete it later on. A new time series will be made, which is of no use right now, but okay. We can't avoid, this is automatic ARIMA forecasting. So I'll go for okay. I've got this result. And look at here. It is showing me ARMA, not ARIMA. So D, there's no issue. So they are not showing ARMA. They are showing 4, 4. Means what we are understanding as we are getting this dialog box. That EViews after running, I'll discuss with you what are the features which EViews usually look at to arrive at appropriate, you know, to know ARMA or ARIMA when you have the stationary time series. So I becomes meaningless in that case. I is already I1. There has to be some decision criteria. So one of the important criteria is AIC, ACAC information criteria, and Schwarz information SIC. These are two popular information criteria which we use in statistics. They are nothing but the some condition which is tested, or in a way you can say error values are tested. Error values. So one method to estimate the error value is AIC, ACAC, AKIK, and this is the AIC, and they might be having ACAC information criteria and Schwarz information criteria. So as you are finding AIC, and this BIC is nothing but Schwarz information criteria. Let me double check that we are not doing anything wrong. Schwarz information criteria, if I am running, just a sec. It is giving me something else, or no, same thing, I'm correct that BIC is nothing but Schwarz information criteria. I'll show you if you want to note down the names, you can note down. ACAC information criteria and Schwarz information criteria. These are the two information criteria which people believe to use. Schwarz and ACAC, AIC and SIC, which is properly known. So if you look at this, this is the output. What we have got that the P and Q value of the ARIMA model so P is 4, D is 1, and Q is 4 is suggested. And the criteria which is used is AIC and SIC. So if you look at the criteria, if you look at this, you will find that this 4 model specification is provided to you, and you will find that this is least. You can, if it is visible to you, this is least value. It 16.0808 is least. if you compare all the values which are there under AIC. Are you with me?
Yes, sir.
Yes, sir.
So what happened when the model is the EViews is giving you one specification of the REMA model, it is using the information criteria to take a call, but will not limit to it. We have 1 or 2 more stages to go. So we are right now taking help to get to know what are the possible specifications. So AIC wise, this is the best. Look at BIC or SIC. So if you look at what is the least value, can anyone really tell me what is the least value? This so far I'm finding 3 to least 16.189, 16.189. We'll stick to it. 189. No, this is least, but this
So
is
there
least.
is
I guess.
0,
0 is least.
16.17.
0 is not here. Where is the 0?
Fourth last, sir. Fourth last.
Acha, this you are saying. You are finding that this is okay. This is least 16.171. So there's nothing like, in that case, it is neither a REMA model nor it is just stationary time series. So there's nothing to check. So we are not using it. Look for second least because I have to use that for certain purpose. So that I need to have a model at least because this will not give me any model. Both are having P0, Q0. So next least you can find out. I think this was this 3 to 1 16.189 is second least value in the list of BIC.
So does 0 2 counts?
0 means, for us that come again.
So P0 and I think that's
P0,
D2.
Q0 means that
Yeah.
neither the lag term of, so there is no term. It's only the constant term.
And
the
sir,
error term.
if
And the
P
error.
is 0 and Q is 2.
That makes sense. P0 means there is no auto-regressive term. Y t minus 2 is y is not there. Lag term of y. Only the random terms, error terms are there up to 2 lags.
So there's a value 16.184.
16.184. We'll use this because we are just trying to show something. 184 you are saying, yeah? This.
Yeah.
ठीक है. So we'll have 0, 2 and 4, 4. Huh? So what we are finding that using the AIC, we have got ARMA 4, and using the SIC, we have got ARMA. We'll write ARMA, but we'll write 0, 2. Are you with me, all of you? So what we have, by doing this inventory exercise, we would have shortlisted 2 models. Are we there? So I'll first of all, just because we have 5 more minutes left, I'll show you how to use the selected model, which is advised by software that this 4.4 is the best. But as we meet tomorrow again I have a class. So I'll discuss that how to go 1 or 2 steps ahead and refine the model or refine the discussion of the model. So right now, let me complete the loop. Keeping that in mind, I'll show you how to make use of this suggested model and how to go for forecasting using ARIMA. So when you are practically having any time series and you are in hurry, so this much will help. You have quickly run the proc. I'll show to you again what I have done. I've just tested for stationarity. I've got a series. I've gone to proc. I've run the automatic ARIMA forecasting. I gone for none, run it, and I'm getting the suggested model, which is 4.4. I could have, selected the option of list that would have also come. This is the least value, which is 16.0808 is shown here. And that is the basis of selection. So then what you can do here also, if you look at, then this series would have been made already. I don't know why it is not coming. We have selected or no. Leave it, that's not our style of doing it. We'll go for estimating equation. and we'll go for D Sensex. D Sensex we are using, and we are writing say C, and we are writing AR. AR was P was 4, so we'll write 1, 2, 4. And then we'll go for MA. For that also we will write 1, 2, 4. Please pay attention. We are still using the same method of running simple regression, OLS regression. D-Sensex is a time series, and we have got this value. And if I run it, so what we are getting, if you look at here, we have got AIC. If you look at AIC value is slightly ahead. It's coming. We have done everything correct. It's okay. It's slightly ahead. I'll check why it is coming. Let me complete the forecasting part. We have done everything correct. There we have. Just let me check that. I'll get back. Okay. Given V44. Same thing what I did earlier. And here I have got again the same model. This having some issue, I'll check it. I'll get back to you next class when I discuss. I'll start with this only. Why there's a discrepancy. There shouldn't have been. It should have been ditto same. So that's not what we are discussing. These are the terms what we are having right now at our disposal. Same, the model specification of the model is same what has been suggested by software. And I'll go for forecast. If I have to forecast, I repeat, there's an option button forecast, and there I will be suggesting that you go for 2, 6. I could have taken all, but I can go for 260 to 262. So if I just go for click, this time series would have been come. As you're finding here, we are having these values, these 3 values. If I show to you both the series together, so this is the D-Sensex values, and these are the forecast values. So this is what I have tried to, though there's a limitation that AIC value should have come same. That's not coming. I'll check it why it is not there. So we have eventually used the ARIMA method to forecast, and these values are first difference that we can adjust to get to know what is the price. And similarly, we could have gone for running the ARIMA model for the return series. If you remember, I had the return series also. So if I want to forecast the return for coming time period, then I could have run the return series, and I could have repeated the same thing. Whatever best specification would have come for ARIMA using the automatic method, I would have gone, and then I would have gone for running the manual way, the way I have done right now, and I could have got the value of forecast. What I'm saying, when we run, then there's, if I just delete it, if I do it again for you, so we wanted to forecast D-Sensex. We have taken a call that PQ44 is the best model suggested by system. So D-Sensex and CAR124, MA124, and that's it. Something. So, okay. So here we have got the model. We are going for, after running the model, we are going for forecast, and there forecast, we are not touching anything for that matter. It will be forecast. You will find that this forecast time series would have come if I opened it, and you are finding we are getting the forecast values, these three values. So that is the quick application. We have to, I'll spend 15 more minutes as we meet next class. And I'll give you the second level of refinement of Ariba model. So anyone has got any problem, I can quickly answer. No questions? Yes, no?
No, sir.